quý vị tham dự và giảng viên danh dự của chúng tôi, ông Thomas Nook. Xin kính chào tất cả các quý vị đã tham gia buổi hội thảo tập huấn ngày hôm nay. Thay mặt chương trình phát triển Liên Hợp Quốc UNDP tại Việt Nam, tôi xin hân hạnh chào đón các chị đến với khóa đào tạo ngày hôm nay với chủ đề thiết kế và định giá sản phẩm bảo hiểm sức khỏe, góc nhìn từ chuyên gia tính toán bảo hiểm. Khóa đào tạo này là một phần trong chuỗi các kiến thức nâng cao các sáng kiến nâng cao năng lực nhằm củng cố thị trường bảo hiểm và hệ sinh thái bảo hiểm tại Việt Nam trong chương trình bảo hiểm và tài chính rủi ro IFF của UNDP và sáng kiến toàn cầu về bảo hiểm. Tính toán bảo hiểm toàn cầu GAIN được triển khai phối hợp với cả Milliman nhằm tăng cường năng lực tính toán bảo hiểm và hỗ trợ phát triển thị trường bảo hiểm bền vững tại các quốc gia mới nổi, trong đó có Việt Nam. Thông qua các nỗ lực này, UNDP và Milliman thì mong muốn hỗ trợ ngành bảo hiểm Việt Nam từng bước có thể tiệm cận đến các tiêu chuẩn và thực tiễn tốt nhất quốc tế, góp phần xây dựng một thị trường bền vững, minh bạch và có khả năng chống chịu cao hơn. Chúng tôi vô cùng được vinh dự và tự hào được đồng hành với chương trình cơ quan quản lý bảo hiểm thuộc Bộ Tài chính, Hiệp hội Bảo hiểm Việt Nam, cũng như trong hành trình quan trọng này, và sự lãnh đạo cũng như là cam kết của các cơ quan này thì đóng vai trò then chốt trong việc thúc đẩy sự phát triển của một thị trường bảo hiểm hiện đại và được quản lý chặt chẽ hơn tại Việt Nam. Chúng tôi trong cái bối cảnh thị trường bảo hiểm sức khỏe tại Việt Nam đang phát triển nhanh chóng, việc tăng cường năng lực về thiết kế sản phẩm, định phí và quản trị rủi ro là hết sức cần thiết nhằm đảm bảo tính bền vững và khả năng tiếp cận và cũng như là bảo vệ quyền lợi của người tham gia bảo hiểm. Vì thế thì cũng rất là mong là quý vị đại biểu có thể thấy được lợi ích của những cái khóa đào tạo trong chuỗi các cái khóa đào tạo này. Khóa đào tạo ngày hôm nay thì sẽ cung cấp các cái góc nhìn thực tiễn hơn về thiết kế sản phẩm, phương pháp định phí, quản trị rủi ro, cân bằng giữa yêu cầu kỹ thuật và thực tiễn kinh doanh và thị trường. Chúng tôi cũng rất là kỳ vọng sau chương trình thì các anh chị sẽ được trang bị tốt hơn để phân tích sản phẩm, áp dụng các cái phương pháp định phí phù hợp và đánh giá các rủi ro trọng yếu. Đặc biệt, chúng tôi rất là vinh dự được chào đón ông Thomas Nook, là chuyên gia từ Milliman với hơn 40 năm kinh nghiệm quốc tế về lĩnh vực bảo hiểm sức khỏe, là giám đốc bảo hiểm sức khỏe toàn cầu của Milliman, sẽ dẫn dắt các cái nội dung chuyên môn này của chương trình cùng với cả các cái chuyên gia khác đến từ Milliman sẽ tham gia trực tuyến và trực tiếp tại đây. Cuối cùng thì xin trân trọng cảm ơn Cục Quản lý giám sát Bảo hiểm, Hiệp hội Bảo hiểm Việt Nam, Ban Actuary của Hiệp hội Bảo hiểm và Milliman về sự hợp tác chặt chẽ và hiệu quả này. Thì rất là mong trong khóa tập huấn này thì các anh chị sẽ có thể là tích cực trao đổi, thảo luận để tận dụng tối đa và có hiệu quả với các cái cơ hội này, và cũng rất là mong là sẽ tiếp tục có thêm nhiều cái cơ hội để chào đón các anh chị đến các cái hoạt động tiếp theo của dự án ạ. Xin trân trọng cảm ơn ạ. Sau đây thì thay mặt ban tổ chức thì xin mời ông Lương Xuân Trường, đại diện cho Hiệp hội Bảo hiểm Việt Nam, sẽ có một vài lời ạ. Xin mời ông.
Thank you, Ms. Mai Phương, for your kind introduction. Good morning, everyone. Please join me to warmly welcome Ms. Queenie Châu, Mr. Tom Slook, Mr. Cherry Chung, Ms. Như Nguyễn, from a representative from Milliman, Ms. Phương Mai, UNDP representative, who are supporting the GAIN project in Vietnam. First of all, on behalf of the Insurance Association of Vietnam and all participants, I would like to express our sincere appreciation to UNDP Milliman for implementing the GAIN project over the past 3 years to enhance the actuarial capacity in Vietnamese insurance market. Today's training session on medical insurance, or we normally call it health insurance in Vietnam, is one of many important activities in the long-term development initiative. We selected this topic, medical insurance, because we think that it is a great subject that is of great interest to both non-life and life insurance company in Vietnam. Um, Health insurance is the fastest growing market segment, insurance market segment in Vietnam in recent years and holds very strong potential for future growth. But we are facing many challenges in product development, pricing, risk management. At Vietnamese insurance market still faces some challenges like lack of experience data, very high uncertainty medical risk, such as a very high inflation, medical high inflation rate. I think that challenge is similar in other markets, but for Vietnamese market, the insurance fraud is very high in my experience. We are facing very intense competition, and it makes our product development and pricing much harder. Our actuaries, we actuaries make our work harder because due to our intense competition. I sincerely hope that through today's training session on medical insurance, we will gain very valuable knowledge and practical insights from Mr. Tom Snook, a leading expert from Milliman who has 4 decades of experience to help us better address the challenges facing the Vietnamese insurance market, facing its company. Thank you, Mr. Tom Snook. So I wish all of us will have a very productive and inspiring discussion and sharing today. Please raise questions to Tom Snook and discuss. Have a great day. Thank you.
Good morning, everyone. As Jerry said, my name is Tom Snook, and I am a principal and consulting actuary at Milliman. And I'm very honored to be here today to talk about actuarial topics in health insurance as part of the UNDP GAIN program. We have a lot to talk about today, and I've prepared a slide deck. Do I need to push something? I prepared a slide deck. Hold on. I've prepared a slide deck and a presentation. I prepared this several weeks ago, and I'll say it's fairly generic. My experience has been largely in the United States. I've done some work in other countries, mainly India, but I have no expertise or knowledge in the Vietnamese insurance system or healthcare system. So the presentation is by design going to be kind of generic. There we go. And as such, if we can manage it, I know there's potential language barrier and so on, but rather than me just lecturing all day, it might work better if we could ask questions. So if I cover a point and you want to raise your hand, or for those of you joining us online, put a question in the chat and ask a question, maybe make a point about how it's relevant or perhaps not relevant in Vietnam. That might make the session more valuable to everyone. And also I want to acknowledge, thank you for allowing me to do the presentation in English today. I do not speak Vietnamese. In fact, this is my first trip to Vietnam. I arrived last week. I did a little sightseeing before business meetings this week. But if I say things or something that you don't understand, just interrupt me and ask me to clarify. All right. And I'm going to do the presentation, most of the presentation today seated because of back issues. Getting old is not easy. But a little bit about my background. So Um, I'm an actuary. I'm an FSA, a member of the American Academy of Actuaries. I've spent almost all of my career in health insurance. I've got 43 years actuarial experience total. Uh, the last 38 of that with Milliman. And in Milliman, I served as a consultant, providing consulting services to, yes. Is this better? Okay. I can hear myself just fine. Um, so working as a consultant, an actuarial consultant in healthcare, my clients have included health insurers, hospital systems, government agencies, and a few others. In 2020, I became Milliman's global health practice director for our health business unit. Our health business unit is the largest of all of our divisions within Milliman. And that means I led and oversaw all of Milliman's health work across the US and across the globe. I chaired Milliman's Health Steering Committee. I served on Milliman's board of directors for 9 years. I will note also in terms of healthcare and healthcare actuarial work, um, Milliman is the largest employer of healthcare actuaries in the world. We have over 1,000 qualified actuaries specializing in doing work in healthcare. Anyway, so at the beginning of this year, my term as practice director ended, as was designed, and now I'm involved in a few new things, including GAIN. And this is my first work with GAIN, my first trip to Vietnam. So let's dive in, shall we? So just overview on what I'm going to cover today. I'm going to focus on private health insurance policies. I use the term medical insurance and health insurance a little bit interchangeably. In my experience, health insurance also includes disability insurance, and I'm not going to talk about disability insurance at all today. It also includes long-term care insurance for elderly people in nursing facilities. I'm not going to cover that today. I'm going to focus on insurance provided by private companies, not government programs. I will note government programs also have the need for actuaries. Some of the actuarial issues are very similar, others are quite different. My firm, we have many health actuaries doing work for government programs. Again, the types of health insurance there are comprehensive medical insurance, which is really what I'm going to focus on today. Disability long-term care, as I just mentioned. I will talk briefly about supplemental health insurance, and if you have questions on that, we can get into a bit. The supplemental health insurance market is much, much, much smaller than comprehensive medical in the US, at least. I mean, it's less than 1/10 of 1% of the size. I'll be talking about in health insurance in two contexts, sort of back and forth. One is group insurance or insurance sold to employers to provide for their employees, and then individuals. So health insurance that is written on an individual basis. And oh, too far. And the sections I'm going to talk about today, I'll start off with product design. I don't know how long that needs to take. I don't think it's going to take the 90 minutes allotted. I'll talk about some of the basics of pricing health insurance. I will spend time talking about data requirements. And as I've met with various insurers here in Hanoi this week, I understand that to be a really important and topic of keen interest to people. So we can talk about that. I'll talk about evaluating trends and emerging experience. Towards the end, I'll talk a bit about evaluating reasonability of results. What to do when you're done with your actuarial modeling and you want to see if your work makes sense. I'll talk about risk management strategies, although much of that will be kind of woven into everything else I talk about today. And if we have time at the end, I will be talking about the interaction of actuarial analysis and technical premium writing with market pressure, the real world of how things work. I will also note, and I don't know if this has been communicated, at 2 o'clock, my colleague, Pang Chai, who leads Milliman's practice in Kuala Lumpur and is an expert on healthcare in Southeast Asia, he will be joining virtually, and we'll be talking a bit about managing high trends and what insurers across Southeast Asia are doing to manage high trends. As I said, I have no expertise in that area. And I exchanged some messages with Pang last night, and if he has some time, he may also touch on data issues. Because I mean that's what he does, right? We're actuaries working in healthcare. We need data to work. So I'm going to start very basic, and some of the stuff, the early part of the presentation may strike you as very basic, very elementary. I will move beyond that, but I want to make sure we start on the same basis. And I thought we could start out by talking a little bit about the role of actuaries in health insurance. And so in setting premium rates, the actuary's job requires balancing two competing priorities. And this is no different for health insurance than it is non-life insurance, auto insurance, life insurance. On the one hand, premiums must be marketable. If you have premiums that you go to market with and they're too high, you've wasted your time. And marketable means perceived by the marketplace as being fair, providing value, and being affordable. If your premiums are too high, you may not sell any policies. And on the other hand, of course, premiums must be adequate to pay claims, cover admin expenses, and provide appropriate margin. And if premiums are adequate, it can create losses for the insurance company, and over a sustained period of time, it could threaten the solvency of the insurance company. So how do actuaries working in healthcare do this work? And I'll just touch on these points real quickly. Much of what we do, in fact, I would say the core basis of everything a health actuary does involves data analysis. And this is different from life actuaries, right? So life insurance actuaries are working with mortality tables, and they're doing financial calculations and projections. We do projections too, but it all starts with data analysis. And the quality and granularity of that data is very important for the sophistication of the analysis one does. Actuaries typically will study past claims experience, of course, developing pricing assumptions that are reasonable and sustainable, building mathematical models, providing expertise to senior management in the management of the company's overall business. Is typical in my country, where there is a chief actuary who is in the C-suite with the CEO and the CFO and the chief marketing officer and what have you. The chief actuary has that level of contribution. And I'm not going to get into this anymore today, but for an actuary to do that, they have to be able to communicate well. They need to be able to communicate technical concepts to non-technical people. And that's a very important job for senior actuaries involved with company management or communicating with company management. Talk a little bit about the key roles that actuaries play in medical insurance. Product design, obviously, and I'll talk about product design in some detail in a little bit. Pricing and premium setting, obviously, that's an important role for the actuaries. Claims management and loss reserving, and tied to that is the point in the bottom of the second row, or in the middle of the second row, financial reporting. So And so typically an actuary will have to sign a statement of actuarial opinion on health insurance business, and that will require a lot of analysis, claim triangle analysis, and that sort of thing. Actuaries are typically involved in regulatory compliance because much regulation affects the work that the actuaries do. And like I said earlier, data analysis and doing innovative analyses in data is a key role for actuaries. And if you may allow me to pause for a minute, it's kind of warm in here. When you said we have a question? Yes.
So we have a question from online. Medical trend is increasing year by year. Does it mean premium should be increased continuously by years to cover this trend? And how can we reflect this medical trend in the pricing of medical insurance?
Well, that's an easy question. That's a joke. Well, yes, trend increases every year. It is common for health insurers to raise their rates every year to reflect past experience and anticipated trend for the coming year. And I'm going to talk about this more a little bit later. What was the other part?
How do we reflect it in the pricing?
So that's hard. I've got a whole section later about trend analysis, and so you can do a good evaluation of your historical trends. Historical trends are not always the same thing as expected future trends. It requires a lot of judgment, requires a lot of data analysis. It requires, I mean, in the best practices, the requires a detailed analysis of not just what your trends are, but understanding the sources of what's causing trend. And that can be, is it hospital claims? Is it something else? Is it number of days per admission? Is it the cost per service? I mean, there's all sorts of things that can happen to drive trend. And of course, trend is more than just unit cost inflation, right? So trend involves mix of services, utilization rates, new medical technologies, new pharmaceutical drugs, many of which are expensive. These all contribute to trend. And then you've also got the part of like, if the population insured is aging or there's some adverse selection going on, then that can have an impact. Okay. Did this. All right, so let's talk a little bit about health insurance product design. And I'll start with medical insurance product design. And there's three main components here, right? There's three axes, in my experience, on three main axes on which medical insurance product design can vary. First one is covered expenses. What expenses are covered under the policy? Second one is cost sharing. So how much is the insured member paying themselves out of pocket versus what is the insurance paying? And third is provider networks. Provider networks are a really super key thing in the U.S. My understanding, which is fairly shallow, is that there are contracted providers that may provide some discounts in health insurance in Vietnam, but that's about all I know. So we'll talk about this a little bit in detail. So covered expenses, this covers eligible medical expenses for insured individuals. So go to the hospital, you go to the emergency room, you get that covered. That's an expense that's covered. And commonly, just sort of the usual medical treatments are covered. So doctor visits, emergency room hospitalization. It will depend on how the policy is designed, of course. Prescription drugs are always covered in the US. I understand here that may not always be the case. Maternity, so pregnancy care is by law has to be covered in the US. From what I understand here, it's sold as maybe as a separate optional rider to the policies. Mental health benefits are typically mandated to be covered. In fact, under federal law, mental health benefits have to be covered under health insurance policies. And in recent years, preventive and wellness services have been included in health insurance policies as well. Again, this is government regulation driving that. Common exclusions from covered benefits include things like cosmetic surgery, weight loss drugs, although that seems to be evolving, experimental treatments, routine dental and vision care, unless they're sold as a separate benefit. Injuries an insured person sustains by committing illegal acts. So if I get injured when I'm trying to rob a bank, it's not covered by my health insurance. And sometimes fertility benefits are excluded. That varies a little bit. So if a married couple wants to have a child and they're having to do some interventions because they're having some issues, that may or may not be covered. I'll note, and I've alluded to this a few times, what is covered and is allowed to be excluded from health insurance policies is a very highly regulated area. And have you all heard of the ACA, Affordable Care Act, also known as Obamacare? Does that mean anything to anybody? Well, that was a big regulation change we made a few years ago, and it has strong requirements of what is called essential health benefits that be covered. Coverage also includes the providers, so hospitals and doctors, facilities must be fully accredited and licensed. So medical care provided by somebody who is not a licensed doctor is not covered under health insurance. And then there's this whole provider network thing that I'll talk about in a minute that drives this as well. But in certain types of health benefit plans, there are in-network providers and out-of-network providers, and some of those only services provided by the in-network provider are covered under the insurance, and unless it's an emergency, and so that's and I'll talk about that a little bit later. Talk about cost sharing. So member cost sharing. So obviously health insurance does not provide 100% coverage. The insured members have to pay a portion of that cost themselves. And this can vary substantially. Again, I talked about in-network versus out-of-network benefits. It can vary substantially between in-network and out-of-network. Types of cost sharing include things like deductibles, co-insurance, co-pays. Out-of-pocket maximum would be a limit on cost sharing. Maximum benefits. Once the insurance company has paid a certain amount, the benefit stops. And then certain specific benefits may have their own interior visit limits. So an easy example is chiropractors. Do you have chiropractors in Vietnam? I don't even know. Okay. Certain alternative medicine providers are limited in coverage. Member cost sharing, of course, is a big driver of premium and the difference in health insurance policies. And then finally, provider network. So nearly all health plans restrict the doctors and hospitals that they cover. And providers included in coverage are called the provider network. And so the way this works is an insurer will negotiate with, say, a hospital system, and the negotiation is, we will include you in our network if you give us a discount off your going rate. And the way those discount works can be quite sophisticated. There are typically two models for how that works. With what we call a health maintenance organization, there would be no coverage, as I mentioned a minute ago, no coverage outside the provider network, with perhaps a few exceptions like emergencies. And the other option is a preferred provider network. So preferred provider network covers all providers, but if you're in network, your cost sharing is much lower. If you go out of network, your co-insurance and deductible may be double what it is in network. And as I mentioned, so the negotiation dynamic between the the physician groups and the hospitals and the health insurers is this reduction in fee levels in exchange for being included in the network, and then presumably steering more patients to that hospital. This is probably the single biggest driver of competitive differences in the United States health insurance market. Very large carriers with a lot of members, have a lot of negotiating power. They are generally able to negotiate steeper discounts than the smaller insurance companies are. And over the years, there's evolved a pretty broad range of ways that these negotiated provider fees. I'm sorry.
Just so the people online can hear you.
So in Vietnam, we don't really have such kind of provider network system. So like basically just one giant network, and insurer don't really build their own like preference or our network system. So do you see that it would have big impact on the pricing and product design? Or do you even think that such a provider network is like desirable for the customer and for the companies?
Yeah. Yeah. So if you have no network, but my understanding is many insurers will negotiate direct pay arrangements with hospitals. Is that not the case?
To my knowledge, I have never heard of a company that actually negotiates a preference pricing with a medical provider. Not to my knowledge.
Okay. The what was the question? Okay. So the impact is one, you don't factor the provider discounts into your pricing because you have no provider discounts. Two, you're probably potentially exposed to greater trend risk, because if you're not negotiating rates with the provider and they just charge whatever, then you're subject to that whatever going up at their decision with no input, no discussion with the insurance company. And so in my view, it increases costs. Obviously, insurance that pays for hospital care where you've got a 10% discount with the hospital would be cheaper than insurance that pays for the same care with no discount. And you got potentially greater risk, as I said, of trend.
But I don't know if it is common in the US, but the pricing for hospital in Vietnam usually public, and they must stick to their public pricings. So I currently I don't see a benefit of such a provider network in Vietnam. So I'm trying to understand what is the advantage if say this network is implemented for both insurance community and for the insured.
Right. So if there's public pricing, so the rates are set by the government, I take it.
Yeah, just not really set by government, but the own private hospital. I think they have to have public pricing, so they have to have a list on their website or whatever, and they have to stick to it. They cannot like check whatever they want.
Right. And we have that too. It doesn't do much, at least in the US, it doesn't do much because they can still change that pricing periodically as they deem necessary, as long as they publish the new rate. And I'm sorry, was another part to the question?
What would be the advantage of such a provider network, like if it's implemented, other than cost control? Because I'm not even sure if it's the effective cost control, because like the in-network provider, they can still can charge very high fees to the public or to the non-insured. So
Yeah. So talk about that a little bit. And so there's the way the provider, like in the way the contracted provider discounts work, there's a number of different structures. The simplest is just a percentage discount over whatever their fee is. And the percentage discount off of whatever their fee is the original old fashioned way of doing it. It's not done very much anymore. It provides the advantage that the fee is lower, so it provides some cost control, but it still exposes the insurance company to trend risk because they can just increase their fees. Now you've got a 10% discount off of a bigger fee. It's common for health plans to negotiate a fixed fee schedule. So, and the easiest way to illustrate that is for physician services. So physicians record ICD-10 codes when they provide their medical service, and the fee schedule will typically have an assigned fee, a certain amount per CPT, or excuse me, ICD-10 code, and that then now those get updated every year, of course, or every other year. But then it does, it's an agreed to fee between the insurer and the provider system, and so it mitigates some of that trend risk. And there are similar structures for hospitals. So hospitals can sometimes just receive a fixed amount per inpatient day for the patients. You even see fixed amounts per hospital admission. So for every admission, with the fixed amount varies by the diagnosis. So you can see as these go on, they get to be more risk transferred to the provider system and less risk put on the insurance system. And that extends even further. It is common today for a health insurance company and a hospital system to negotiate a bonus pool. So they set a target payment, like aggregate. Here's what the cost will be for all hospital services at your hospital, and if the actual comes in below this negotiated target, then that savings can be split and shared between the hospital and the insurance company. And then finally, in the most extreme example, there's what we call capitation, which is where the insurance company pays a provider a fixed amount per insured life per month to provide all the medical care that's necessary under the scope of the contract. So as you can see, is along that continuum, there is an increasing degree of the provider system, the health hospital system, physician group, taking on an element of actuarial claim risk, claim volatility risk. I mentioned in the introduction that in my career, I've done a lot of work with health insurance companies, but I've also done a lot of work with hospital systems. And this is why, is because they start taking on insurance type risks in health insurance, and actuaries can provide value there. That's a long-winded answer, but I hope I addressed your question.
Yes, thanks. It's clarify a lot. Thank you.
Yeah. Okay. All right. All right. I'm going to talk just for a little bit about supplemental health insurance. And for supplemental health insurance, I'm going to split into three major types. One is accident indemnity, one is critical illness, and the third is hospital indemnity. So accident indemnity typically covers claim costs or losses for injuries only. So if you get sick and need to go to the hospital, that's not covered under an accident policy. Typically, the accident indemnity policies will have fixed benefits. So they'll have a schedule of benefits. If you have an accident and go to the hospital, we'll pay you this much money. And those fixed indemnity benefits are always paid in addition to whatever other health insurance the insured member may have. So they don't coordinate benefits. There's no subrogation. It's just simply an additional payment. Under accident insurance, the covered services are typically things like ambulance, emergency room, hospital, physician in the hospital, and so on. And sometimes those accident indemnity policies may have other benefits attached. There may be AD&D, accidental death benefits provided as well. For critical illness, this covers losses due to a certain list of specified illnesses. And this used to be called cancer policies, but now it covers a lot more than cancer. And there's a face amount, like for life insurance, and if you get one of the illnesses listed, you get a percentage of that face amount depending on what the illness you get is. Typically, critical illness cover things like cancer, heart attack, stroke, organ failure. So very, very serious medical conditions. They also might include other benefits, such as payment for burns or payment for blindness. Again, this is typically sold as a supplemental coverage. People will usually have their own comprehensive health insurance benefit, but then they may also buy this. Critical illness policies are also very popular in Japan. They're very popular in Japan. And finally, hospital indemnity, like the name suggests, covers losses due to injuries and sickness, and typically including pregnancy. There's a fixed daily amount. The daily amount is not tied to any medical service provided. It can be used for any purpose. If you're in the hospital, you're going to get a certain amount of money per day, and you can use it to go buy a new television if you wanted to. Benefits will be paid up to a maximum number of days per year, and there may be other benefits associated, such as emergency room, ambulance, and so forth. This supplemental health insurance is a very specialized niche of insurance in my market. So in the U.S., the size of the supplemental benefit insurance is about in terms of premium volume, it's about $9 billion per year. And for comprehensive medical insurance, the size of the market is over 1,000 billion, so over $1 trillion. So that's the relative size. Before I move on to pricing, I'll pause again and see if there's any questions. Any questions online? Okay. All right, so I'm going to talk about the very basics of pricing health insurance now. And here's the classic formula that everybody probably already knows. Premium needs to be equal to the expected benefits you're going to pay, claims, administrative expenses, including marketing expenses and commissions, and your necessary margin to contribute to capital. That's not unique to health insurance, obviously. And in health insurance, and most of what we talk about, we'll be focusing on expected claims. So expected claims, again, the simple definition is this is what we expect to pay in medical claims in a period of time, say a year. Expected claims or the claim cost level incurred depends on the frequency, severity of medical services received, the price paid for those medical services, the benefit design, member cost sharing, and whatever limits there may be. And this is, as noted, is the primary part of the health insurance premium. Typically, it would be 85 to 90% of the premium in my market would be expected claims. Next up is admin expenses, and this is, again, not unique to health insurance. So you've got the admin of actually running the business, marketing expenses, regulatory costs, taxes and fees. Costs can be typically expressed as a fixed dollar amount or as a percentage of premium. And the key here is that to do this right, you really need strong accounting on understanding what your expenses are to run a line of health insurance business, to appropriately allocate health insurance. Finally, the last component, risk margin and profit. I think this is obvious what this is. In the margin is warranted in any insurance program because there's a need for the insurance company to have capital so it can cover losses. And the whole premise of insurance, of course, is that the insured pays a premium now in exchange for a promise to receive payment later. That's any kind of insurance. And payment later if certain conditions are met or if it's necessary. And so there's an inherent need for the insurance company to remain solvent. And health insurance company insolvencies can be a problem. And so there's a need for that. There's also there's capital required to run health insurance problem, and people want a return on that. Am I still having problems? Am I here? You can't hear me if I do this? Online. Thank you. My key point here is margin is not just profit, right? Margin is the buffer that's needed to ensure long-term sustainability of the insurance program, of any insurance company. All right, let's talk about pricing.
There's a couple of questions coming online.
Okay.
If that's okay. First question related to the product design. The question is the product design that you've just mentioned are standard. Any innovative designs that you have seen across the globe recently?
No. And I say that, as I mentioned earlier, these are so heavily regulated that they're it's difficult to be terribly innovative. I mean, you do see some people trying to get creative with the ways to structure member cost sharing. But I've seen that from time to time over the years, and it never amounts to anything, and people just revert back to the standard way. I guess I'm being a little simplistic. So I mentioned in-network and out-of-network benefits, and actually I've seen 3 tiers. So in-network preferred, in-network not preferred, and out-of-network, which you got 3 tiers of benefit levels. That also is not terribly popular.
Second question coming online. If the assumptions deviate substantially from the actual experience, when should the insurers revise the premium rates? Is there any threshold or warning margins? Is there any threshold or warning margin?
So health insurance is typically sold as 1-year renewable term. So typically every year, the actuary is going to update the premium rates. And the updating the premium rates will reflect emerging experience and trends that have happened and are anticipated to happen. So I would say every year is the short answer. And those contracts are 1 year, so there's generally no ability by the insurer to change premiums in the middle of the contract. But I would say, typically, that's a big part of what actuarial departments and health insurance companies do. They figure out what their trends, what their premium rates need to be for next year and how they need to adjust pricing. Is that it?
One more.
Okay.
One more just came in. Questions keep coming in. From the premium formula, is there any framework or mechanism used to ensure that premium is fair to the customers?
Yeah, well, from a regulatory standpoint, sure. And there are different ways to do this. The easiest way is one of the simplest ways we do, at least in the US, is the regulator may say, or the government may say, you have to have a loss ratio, not a combined ratio, but a loss ratio, at least a certain percentage. And if the loss ratio falls below that in a given period, you have to actually refund premium to the insured members. That gets very complicated to do in practice. And there's all sorts of complicated formulas because now it's done on a 3-year averaging basis. So just because you have one good year doesn't mean you have to refund premium. It's averaged over a 3-year period. So minimum loss ratios with a refund provision. If the loss ratio is so high, there's no provision for getting more money in premium. So it's a one-way risk sharing. Another way that you see that done is in close regulation of pricing. There can be, so I talked about margin and profit in the formula. There could be explicit caps set by the government and how much margin you can have, or it could be just a component of things that the regulator uses when they're reviewing rates. And then there's also, especially in certain markets, very tight review and regulation, but very tight actuarial review of the rates that are filed. So the government has actuaries who will review the rates that the insurance companies' actuaries have filed with the government, and they might question assumptions. They might say your trend assumption is too high, lower it. So we see that. So this varies by government jurisdiction, but in the most active regulators, they are serving very much as advocates for the consumers. Sometimes in the U.S. to the point of creating rates that are actuarially unsound, don't cover claims.
a few more questions coming in, and some of them are specifically related to the Vietnamese market. So we do have a local Southeast Asian expert doing the second part of the training later today. So I will reserve some of that questions to the later session online. So there is possibly one final question for Tom before you move on to the next question, which I think is quite interesting. What role should reinsurers play in medical product pricing?
What role they should play, I don't know. What role they do play and how they're useful, I can talk about. So for a health insurer that may be small, that are new and not have any experience, the reinsurer can be a valuable source of information. They are covering similar business across many, many carriers. They are likely to have more and better data than a startup health plan will have. So they can be a great asset to assist in pricing, depending on how much of the risk gets offloaded to the reinsurer, right? I would say that in the US, large, substantial quota share deals where most of the risk is offloaded to the reinsurers is very rare. You do see typically stop loss, either specific stop loss or aggregate stop loss. There is some quota share that exists, but it tends to be very expensive. But the reinsurers are there, and they are trying to win your business, so they will often provide what is essentially a light level of actuarial consulting services as part of their package. All right, so we're going to talk now about pricing methods. And so in this way, I'm going to talk about different ways to set premiums in health insurance, talk about the advantages and disadvantages of each, and in fact, how to combine them in practice. And we need different methods basically because data quality and volume can vary substantially from one block of business to another. It can vary by product, so different kind of health insurance product. It will vary by the population size. We're all familiar with credibility theory, I presume, law of large numbers. And it will vary by market maturity. A brand new startup is got limited data, and somebody with many years experience has obviously got a lot more data. The key thing I'm going to walk away from here today. So I'm going to talk about experience rating approaches and manual rating approaches. And the key idea is to use more experience rating approaches when historical data is strong, and rely more on the manual rating approaches when data is not strong. So when I talk about experience rating, what do I mean? This is simply using past experience of either a large employer group or a specific portfolio, using past experience to set future premium rates, 100% completely. So basically the analysis is take historical experience and project it forward. And the projecting forward is the key here. You've got to reflect trend, obviously, changes in demographics, changes in benefits, and so on. And so it's not as simple as it may appear on the surface. And as I mentioned, this is typically used for products or groups that have more years of quality data. And the key here is it kind of the underlying presumption of this pricing method is that past claims on a specific population are a reasonable guide to set expectations of future claims, which may or may not actually be true. So the advantages here is that, the advantage to experience rating approach is that it is tailored to a specific population's risk. And so you're not using outside data, which may need adjustments or may not be applicable, is tailored to the population's risk. And generally, in my experience, is perceived by people as fair. The disadvantages to experience rating is, first of all, it can be unstable, sometimes very unstable for small populations. Small populations obviously have a lot more claim variance just for random noise reasons, statistical reasons. And so that can result in very unstable premiums for smaller populations. Experience rating tends to be very sensitive to one-off kind of large claims. Large claims happen, and they happen almost every year. But if you have an unusually high number or an unusually low number in 1 year, it could skew your results. And again, like I said, this assumes past patterns will occur, and the actuary needs to think about, is that a reasonable assumption? Are there reasons I would think that past patterns may be disrupted to some extent in some way? In contrast to experience rating, I'm going to talk about what we call manual rating, or you might see it as table rating. So manual rating is a standard set of rates from a larger portfolio of data. So it may be, okay, we don't have enough data on just this block of business in our insurance company, but we've got other blocks that perhaps we can use their experience, modified or adjusted to get a credible data set. It can also mean external data sources. External data sources gets to be increasingly, what's the word I want? The further away you get from your own insured population, the risk of mispricing increases. And so external data sources, while better than nothing, certainly, will require careful consideration and almost certainly some sort of adjustments, which may be just adjustments which are based on actuarial judgment. The rates for manual rating, will typically vary by age and gender, regions, benefit design, and this is typically used with new products or new groups that have very limited data. The advantages of manual rating are, if you don't have experience, then it can be useful. Manual rating is consistent. It's easy to administer, and can be useful as a starting point or benchmark in your rating process. The disadvantages, of course, is that it could be an invitation to adverse selection. So manual rating is less tailored to each specific group or population. And that means it may be uncompetitive for good risks, and it may be too low for poor risks. And finally, the manual rating will need regular updating as you see how your experience actually emerges compared to what you've assumed. I'm going to talk for a minute about community rating, just as an aside. I'm saying this is sort of a third option. I don't recommend it, but so the community rating means basically you have the same premium, health insurance premium for everyone. There may be some variation by age. That variation by age maybe limited. And by limited, I mean, so for example, in certain markets in the US, like the actuarial age cost loop. So if you got cost here on the y-axis and age here, and as the age goes up, costs go up. And at the bottom, let's say 18-year-old, and compared to that to say a 65-year-old, the 65-year-old, according to our data, maybe like 7 times the cost of the 18-year-old. And the law in the US limits that difference to 3 times. So it flattens that cost distribution. So of course that creates subsidies where young people, if they buy the insurance, are paying more to cover the some of the costs for older people. Community rating is used only for 2 reasons. One is if it's required by regulation. And 2, you will see it in lower risk products if you need like very low premium products that need administrative simplicity, where your exposure to risk is limited, and you don't want a complex premium rating structure. You just want a rate you charge people. And again, a community rating obviously has a high risk of adverse selection. High cost members want to join, low cost members are less likely to join. And then sort of the way it works in reality is I'll call blended or credibility rating. And here is where we will typically combine experience-based rates and manual rates. So I talked about experience rates and manual rates, and we'll combine those in a way that that sort of blends the two, and typically done through what's called a credibility factor. So credibility factor range from 0 to 100%, with the percentage being how much weight you give to the experience rating. So a group may get 75% credibility in its rating, which means you give 75% weight to the experience and 25% to the manual rate. That credibility factor is said it based on the size of the population that you're rating. Large groups, large populations rely more on the experience data, and in small groups you rely more on manual rates. And I've got a very simple mathematical example here. I have no idea if those units are anywhere close to reasonable, but I Googled it and took a guess. So obviously the group A with 50 members has much less credibility to their experience than group B with 1,500 members. I want to pivot to some specific considerations for individually written business. So not including group business here, but just retail business. Policies that are issued on an individual basis. And of course, the defining characteristic of an individual market is that there is a very strong adverse selection risk. When people decide that if they want to buy health insurance or not, they're making an informed decision in which they make a cost-benefit trade-off. And the cost is the premium they have to pay. The benefit is the value they see in the health insurance coverage. And if a person is in poor health, they are going to view the health insurance coverage as having more value. If somebody is very healthy, they will view the health insurance coverage as having less value to them. So that obviously skews the risk and creates a strong adverse selection risk. And also note, in individual business, because it is sold on a person by person basis, that means marketing expenses tend to be much higher. And that's an important factor. So because there is such a strong adverse selection risk, there is typically some degree of underwriting or risk mitigation. An insurance carrier may do medical underwriting, have the insured complete, or the prospective applicant complete a medical questionnaire, and then evaluate the results of that questionnaire to set a rate or decide on whether to issue coverage enough or not. Pre-existing condition exclusions, we're all familiar with those, right? If you have a treatment for which you got, if you have a condition for which you received a treatment 12 months before policy issue, then it won't be covered during the first 12 months that you have the policy in force, as an example. And then, of course, waiting periods. Waiting periods is another way to limit or mitigate adverse selection. Coverage for certain types of benefits are not available until the person has been insured for a while. And the most obvious and easy examples to give of that is if there is maternity benefits included in the individual health insurance policy. There will be a waiting period of at least 10 months and perhaps as much as a year, because you don't want somebody to buy maternity coverage when they know that they are already expecting a child. So pricing individual business typically starts from manual rates. The rates then may be adjusted by the underwriter who is administering the business for each specific applicant's risk. How you can do that is typically limited by government regulation. Rates, as with the other cases, can vary by age, gender, region, and benefit option. And of course, you have to consider the effect of cost sharing on this. I'll pause there. Any questions so far on any of that stuff? Hi. There's a microphone somewhere.
I have a question on the cost sharing method for the medical reimbursement product. Is there a situation? So from our customer survey, they said that they don't like deductible. They want they understand copay. They don't want deductible. So is there any specific situation where copay are more preferred than deductible, or where deductible are more preferred than copay in terms of the pricing, the technical pricing of the product?
Yeah, so that's an interesting question. In my experience, these days, typically only certain limited benefits are covered by copay as opposed to deductible. A standard, traditional, simple office visit to the physician. When I go to the doctor, I have to give $25. That's my copay, but I'm not subject to the deductible. Pharmaceutical prescription drugs, they will have a copay. Emergency room will probably have a copay. Everything else tends to be subject to deductible and co-insurance. And Jerry, there was the question from online about innovative policies, and I didn't go into much detail. An innovation I saw attempted a few years ago was to eliminate all co-insurance and deductible altogether and only go with copays throughout the entire policy. It didn't work. There were risk issues. It wound up costing more than people thought it should, and so it wasn't popular in the marketplace. Have I answered your question?
So I understand that, like, there no technical consideration rather than just the market trend or the customer preference to use either one of those.
Yeah, I mean, the customer preference is perhaps apparent because a copay, you know how much. A fixed copay is a fixed dollar amount, and you know how much you're going to pay. If you're paying, and deductible is a bigger number, and the big number can sometimes be a little scary for people. And with co-insurance, you know, I have to pay 20% of what? I have no insight to, you know, the typical person on the street does not have, unlike actuaries or underwriters, does not have insight as to what it costs to go to the hospital for a treatment and get an MRI and what have you. So yeah, so I mean, it's common that the copays are preferred, but as I said, when I've seen in experiments to lean on that, it has not succeeded. And I think, so the common structure of easy things like pharmaceuticals, physician office visits, that's how most people are interacting with their on a very low level. It's only people who get really sick that have to deal with deductible or co-insurance. They're not really sick, but have, you know, hospital care or what have you. And so it sort of limits consumer exposure to that non-preferred cost sharing approach.
Yeah, thanks. Yeah, I still I have one more question.
Course.
Yeah. For the waiting period, I want to ask about the benefit that the customer can plan, such as a maternity benefit. So we usually set the waiting period longer than other benefits so that the cost can be controlled or the cost can come later. But when the government step in and said, for example, the maternity leave, maternity cover, we only can set the waiting period, say, to 270 days instead of, say, 300, instead of, like, say, 1 year. So is there any other way to control the cost, the risk of such like pre-planned benefit?
Yeah, interesting point. If the government says you can't do it, then you can't do it, obviously, right? So and 270 days makes sense, but it's cutting it pretty close. And is your company issuing maternity as a separate benefit that they have to pay extra for, or is it incorporated with part of the medical?
It's a separate, come with separate premium rate.
Yeah.
Yeah.
Okay. Right. That increases the risk because people aren't going to buy that unless they want to try to have children, and so at that point, in my opinion, it stops being insurance. Right? It is just, you pay us this money and we pay for your delivery, and you can expect the premium for that is the cost of a delivery spread out over time, and plus a loading for admin and so on. And it's at that point it stops being insurance, in my view. And that used to be pretty common early in my career, and it is unheard of now, because when you bring the maternity in as part of the all the other medical benefits, then you don't get anywhere near the adverse selection at issue. That's hard to do if you do that and your competitors don't, because then you've got an expensive premium. So really that only works if the government says you have to do it that way, and everybody has to play by those rules. That may not be a satisfying answer, but it's how I see it.
I think my last question is more on your experience. Do you see in other countries they offer the retail medical reimbursement on, say, simplify underwriting option, guarantee underwriting option, or mostly on full underwriting?
Well, and there's a sort of an option in between those two, which is simplified underwriting, but then fuller underwriting if there's a claim, because then you make a decision about renewal, or you can audit to see whether the person lied on the simplified form. And I would say In other markets, that question is largely moot because individual underwriting, I'm sorry, my perspective is strong on the US, so I'll admit to that. But I believe it's also this way in the Netherlands, in Ireland, where there are private insurance markets. The government does not permit underwriting. And that there's a whole nother conversation there we can have about how you manage risk in that environment, which I could get into if you want, but I don't know if there's interest, broad interest. So no, I don't think it's like I said, the medical underwriting is something that's much less done, and in most I'm aware of. For comprehensive medical insurance, it's not permitted by regulation.
Thanks.
And of course, that creates huge adverse selection risk, which again, there's other ways you have to combat that. Any other questions? Do we have anything online? Okay. All right, I'm going to move now to some broader combinations. So we've talked about sort of techniques and so on pricing. Now we'll just talk about some considerations to think about when you're pricing. So less technical and more what the things to keep in mind. And the ones I want to cover here are benefit design, the market is, regulatory environment is, what your company's operational capabilities are, and again, provider payment arrangements. I'll cover each one of these a little bit one by one. All right, so start with regulation. And I've alluded to this throughout my talk today, but in many markets, in many environments, regulations play a huge role in the actuarial premium rate setting approach. There are, as I've mentioned, required benefits. There can be restrictions on the ways that you set your premium rates. There can be caps on profit. There can be caps on year-over-year premium rate increases. Regardless of what the actuarial numbers say, there could be a government cap saying you will not increase your rates more than 10% 1 year over next. When that was first implemented, we saw a lot of 9.9 rate percent increases being filed because it was just under the 10% cap. Benefit design is also important consideration in ways that may be more subtle than just the obvious. Richer plans, and when I say richer plans, I mean plans with greater benefits, lower member cost sharing. These richer plans have, higher costs, but it's not just because of the cost sharing difference. There's a concept called induced utilization, which is an unfortunate name, but induced utilization is a thing that's been demonstrated in multiple markets across the globe. The less cost sharing an insured person has with their health insurance, the more healthcare services they will use. And so you can have, so just if you think of an actuarial pricing table and you're looking at your hospital utilization rate and your hospital cost per day, and the cost sharing you take out of that, and it's a simple arithmetic to figure out what the net premium would be. That utilization rate will differ. If it's a low cost sharing, the utilization will be higher. If the cost sharing is higher, the utilization rate will be much lower. And that's a really important consideration in pricing. It drives a lot of our work. And then, of course, and we talked about this probably longer than I intended to earlier, but the provider arrangements that you may have, and this is like, fee for service versus discount off of fees, off of scheduled rates, off of going even so far as capitation. Well, clearly, if you have those in place, impact pricing. And I'll note here that strong contracting, so being able to negotiate well with hospital systems and physician groups, really can reduce costs and make the plan more competitive in the marketplace. Provider arrangements are the single biggest driver of competition of health plans in the U.S. Some other considerations to think about include operational or market considerations. There's so operational is not just paying claims, but how well does your claims department pay claims? Are they pretty accurate, or do they make errors? Every claims department in health insurance everywhere makes errors at some point. The key is keeping them manageable and under control, not at too high a rate. Quality of claims administration can also involve a conversation about identifying and putting a stop to attempts at claim costs, claim fraud. Claim fraud is a huge issue in the United States. President Trump has talked about it in public speeches recently. It's a tricky thing on how you manage risk claims fraud, but it's always a huge thing. The better you are at that sort of thing, the more confidence you can have in your premiums going forward. How sophisticated are your IT systems? And how good are you at data capture? I'm going to talk about data at some length here in a little while, but that's that, like, the better. I mean, like the operational, the IT systems. If the IT systems you're using to administer and collect your premiums, the better your IT system, maybe the more sophisticated you can make your premium rate system be. And then finally, of course, and I just alluded to this, the ability to handle complex rating structures. And then the final consideration is market. We'll talk about this more later. The competitor premiums and products, affordability, how much can the potential insured afford to pay in insurance, and then of course your distribution channels and commissions. There are agents who sell insurance that are better than others, and I don't mean just sell more. I mean they sell a higher quality risk. Another consideration to think about in pricing is the technical premium versus the market premium, and I'm going to get into this in more detail later. So when I'm talking about this in these terms, technical premium, I mean this is the rate that the actuarial analysis or the underwriting analysis says we should set. In our best estimate, this is the rate we think we should set to cover our costs, cover our admin expense, and cover our margin. Contrast, the market premium is what your competitors are charging, what consumers are expecting to pay or willing to pay or able to pay. And again, this is influenced by your competition, it can be influenced by regulation, and of course, it's general overall health insurance affordability. It is sometimes tempting, and I see this with younger actuaries sometimes, to rely too much on the technical premium and not be able to engage in considering the market premium. In reality, to succeed, you have to be able to balance both of these competing interests. And for the actuary, that means you can't just accept the model rates. You need to decide how you want to respond to market realities. So I'll talk about this later. I still remember an incident very early in my career where I'd done some analysis and presented some rates, and the marketing officer in our company just jumped all over me and told me I didn't know what I was doing, even though the rates were technically sound, but you know, that my rates were flawed because they wouldn't even begin to compete in the marketplace. I still remember that because it wasn't pleasant to hear, but it was a thing a thing you have to deal with. So it's like, and like I said, I'm going to talk about this later and about certain things to think about when you do that. I'll pause there. Any questions on what I've covered?
There's a question online. Do you think there is unhealthy competition in the insurance market among insurers? Are some products adding extra benefits that may not add value to customers? For example, critical illness products originally focused on the big 4 illnesses, but many now cover over 30 or more conditions. Does broader coverage improve value, or does it make it mainly the product more expensive? What controls or regulations should the regulator put in place to ensure healthy competition and product customer interest?
That's quite a bit there to think about. I certainly have seen in my career unhealthy competition in health insurance marketplace. I've seen that. I wouldn't say it's the normal condition, but I've seen it happen. It's not rare. And in my experience, what it takes is, so you've got unhealthy competition, it drives the rates down. It may drive the rates down to a point where they're not sustainable. And then you may have an insurance company insolvency as a result, which creates a lot of news. It's in the headlines, and it puts policyholders without coverage that they've paid for. It's an ugly situation, and that usually makes the market reform and behave itself for a while. I don't know, like if the question is about the Vietnam market today, I don't know if the competition is healthy or not. Regarding critical illness and packing the covered diseases, I want to first of all caveat this by saying I am not a critical illness expert. I have some knowledge of it because I am a health actuary, and I led our firm's health work. We do some of that work, a fair amount of that work. So I'm not an expert, but my understanding is, like, I don't have firsthand doing the work experience with critical illness. But the expansion from a very limited number of illnesses to a broader number, and I wasn't quite sure if I got the gist of the question. Yes, it certainly drives premiums up. No, there may not be value because I mean, one of the issues in critical illness policies is that the premiums are so low, it becomes difficult to cover administrative expenses. And by getting the premium up, you're not just getting profit up, but you're actually creating more capacity to cover administrative load. And I expect that on some of those additional, based on my experience in other markets, that some of those additional new diseases that are covered are potentially overpriced. A list of 30 covered diseases is more impressive looking than 4. And so the market responds to it. Whether that constitutes unhealthy competitions, I can't say. All right. Any other questions? Okay, so we scheduled for our break soon. All right, well, this is a logical place to stop it because we want to data. Is it out there now, Mike? All right, so let's take a break, stretch our legs a bit, and how long is the break scheduled for? Half an hour break. All right.
No, so maybe we can shorten to 15 minutes so that we have more time for the later. It's up to you.
I'm not hurting on time here, but okay.
So 15 minutes.
15-minute break, I'm now told.